Ladies and gentlemen, let me just make sure I got my AirPods here connected. And then we'll start going. Happy Friday. Happy LinkedIn Live again. This is something that we like doing. Something that I thought about that there's a lot of people who are probably going to be interested in maybe seeing us do this live in our office. If you're in the Miami area on a Friday, I practice what I preach. We'll probably sit here, do this, and then on Friday I have a gathering of people. I call it the 305 Illuminati, and those are all family offices from New York and Boston who have moved down to the Miami area, notably Coral Gables. Not really too many people on the beach, mostly in the Brickell area where I live, and that happy hour is just great. So it's good for like building relationships, but also building intimacy amongst families. So if you're in the Miami area, let me know on Fridays. We like to host this at 3 o'clock, and then we go back, and then we start meeting people around 5 p.m. At any one of the places in Miami that we're together with. I am. It's been a long week for me, and I put together something, but I think we're going to be going a little more direct in the next few months, or the next few editions that we do this. We've just finished our, I think, third allocation in the Stripe, maybe four. That was at the beginning of the month. And then we have been working on an incredible real estate deal with one of the most serially successful and wealthiest real estate families in America. And that's Class A industrial flex that I like. We have a track record with that. And then also, we're also doing our ninth and probably maybe kind of sort of final into SpaceX. And that's taken all of my time. And I can tell you that I woke up this morning with 34 text messages in response to an email that went out at 6 a.m. And it was pretty interesting how even people on the West Coast are opening my emails all the time, which is just in. Yeah. I want to make sure I'm in. You guys can hear me? Yes, I have problems with, okay, Esteban, am I not in? I think, can people see this? Kevin, can you tell me something? Anyone who's on here, tell me if you're hearing me or not. Maybe I need to get out. Okay, says it's perfect. So we're going to go over the case studies and how we're able to do this. I think there's a lot more people that would like to know about the technicalities about actually calling the capital that's coming in right now for these opportunities. We don't like fund structures. Funds are a four-letter word to family offices and the people we invest with or invest in us. And the reason is because the fund industry has largely become monolithic utilities where they just sit on assets and collect fees, but there's no alpha or there's no real return on this. And families are kind of tired of it too. And then also, they clip fees, against the AUM or the investment amount. And people have been in, funds that had a term for 7 years for 10 years now. And when we do these deals, and I can tell you if you're starting out as an emerging manager or just talking to anyone else, you want to use an SPV structure. That's something we can talk about a little later, maybe in another episode, but we do have a mastermind where we meet, where we go over this with our general counsel. One of the things that I'm excited about is that Florida put together something that will be out in January, and that's called the Master Series LLC structure, which makes it very easy for you guys to move capital into opportunities. I like saying, that structure allows us to say mice go where elephants can't, and that's given us an opportunity to move really quickly where we had to, where 3.5 years later, Saudi PIF has invested $50 million into one of our opportunities. So this is something where, we go through this. There's also the relational point that I think I need to talk about. I talk about this, and it's actually a book, my fourth book that I might be putting out early next year. I'm not too sure. But it talks about how we call the capital and how to manage those relationships. So there's three parts to it, right? So when you're out there, and anyone who's been with me for a while as I've been talking about this, there's three steps. And the first step is creating your brand. Okay, so that's putting out content. On a very extreme case, Kim Kardashian has a strong brand, right? She's always got content out there. She invented the selfie. Number two is inviting them into your church, all right? And that means you have to get them on your email list. I'm sure if Kim Kardashian was thrown off of Instagram, she would still have at least 10 million people she can email and, maybe do like a blitz scale or, a fire sale on one of her products or something and make millions of dollars. And so you got to do that, because when you communicate with people, and this is where a lot of emerging managers sort of drop off, is that they feel as though they're too important to be putting content out there. And when you're putting content out there, people either like it or not. It doesn't really matter. It's just building your brand. And with ChatGPT today, it's easier than ever to do this, and you can just program it. I write everything myself because it's usually a function of what people have text messaged me or on LinkedIn or emailed me questions about things that have happened, and I use that sort of as the sounding board to put everything together. And then the third part of this is the execution. How do you monetize these relationships? You have a deal now. Okay, great. How are you going to monetize these relationships? And that's something that we go over in my mastermind, but we'll be going over that a little bit. So family offices, I'm going to define what I think a family office is. Anyone that has over $100 million in investable assets. That doesn't mean that they're sitting on $100 million worth of real estate that's illiquid, although they are families by that proxy. But you see a lot of people who are in illiquid things, which means they can't invest. And I am very cognizant of this. There's people in Miami who say they're family offices. I can tell you they're full of shit just by looking at them. You ask them a few questions and they just, they fold like a paper crane. And that's what it is. And there's two types of families, and I'll start every episode with this. There's the operating families, which have been around for a while, and they have operating companies, it could be franchises, for example, that throw off tremendous free cash flow. And they're like, well, what do we do with this? Well, they go into, our deals, and especially real estate too, because that's really, the real preservation of wealth. And it's also, real estate is really just a tax efficiency scheme when you look at it. There's different types of capital and there's different types of egos that go into each deal. And I'm just going to tell you what it is by going through this. So if you allow me to continue. All right. Not all capital. This is this is very interesting, and this is something that nobody really understands. I always know when I'm dealing with a young Turk who's pitching me, and they're pitching me the returns, or worse yet, an investor is naying my deal because he can get a higher return, but he doesn't understand the risk profile, right? If you were to ask someone if they would take a 9% return or a 10% return, but you had to take double the risk to get the 10% return, 75% of the people would choose the 10%. And that's the way people look, except wealthy people. Because what's happening is that when you're chasing the highest return, you're putting yourself in too much risk. That to me is a sign of a middle-class investor that does not have a lot of cash. Maybe someone with less than $10 million. $10 million is really, if you really want to be considered affluent to be able to retire, you need at least $10 million today. That's a number a lot of people don't like to hear, but it's it's the truth when you look at cost of living. I mean, now even our health insurance has gone up too, and it's really incredible. But with that, I always see people doing this, and if you really want to see a proxy for this, there's a site that I use called prosper.com, and Prosper is where you put the gambling money, and you can either lend money to someone that has great credit, or you can lend money to someone who has bad credit. And those are usually tiered A, B, C, D, and then NR, no rating, like meaning it's really bad. But those are all of those that have 25% returns are scooped up the fastest, which is amazing. So when I go on there, I'll get like an email alert, and I'll be like, "Ooh, this is interesting." Before I go to bed, somebody just put something up there. It's a 25%. Next morning, it's taken down. So people, especially Americans today, love risk because they don't have enough money and they don't have enough time. So they need to do that. Unfortunately, if these are people who are 1099 or whatever, their capital is much higher than anyone else's, especially someone that has passive income coming off of, say, yogurt franchises. The operators think that every dollar wants the same thing, and it's not. Different capital needs have different needs and wants. Okay, I can tell you that people today, and I wrote my third book on this, Investing Legacy, how the 0.001% invest. People are looking for status, they're looking for rights, they're looking for a little more. What else does my money get for me? Money has a voice today. The higher the dollar, the better the terms. That's just the way it is. Whoever holds the gold makes the rules, and especially with our co-GP structure that we're working with right now in our Class A industrial real estate deal, it makes it much easier for people to come in as a direct investor into these things. Some people are looking for, they're looking for something steady. They're looking for something, like if they're getting a 33% IRR net levered on a Class A industrial building, they're happy with that, right? Some people don't have access to that. And it's all about the access to a lot of people. And even very wealthy people between 100 million and 1.2 billion, say, that have accounts in private wealth management at JP Morgan or Goldman Sachs, for example, they're not seeing these deals. They're going right into funds. This episode is not about deals. It's all about how capital thinks when no one is pitching it. All right, we're doing good here. Not bad for a Friday. So let's see, open this up a little bit. Okay. Family offices don't ask if it's a good deal. If I'm presenting it to them, I hopefully have the reputation with them that they're going to answer my phone call. And it also is a two-way street too. There are people, if I'm, and our deal book is booked, our deal book is full and fully subscribed with commitments until the middle of 2026. It's December 2025 right now. And, if I ever needed deal flow, there's probably 3 people I can call who I trust, because if they're investing in it, then I want to know about it too. And it all has to do with the relationships you have with smart people who are in this business. What job does a capital serve? Okay, what does this do? I'll tell you what it comes down to is that, I've known some very, very wealthy families who have worked for other wealthy families. And if you look at it, some people are just saying, before I look at anything, and we don't have to invest, it has to be a minimum of 15%. Okay, that is the most important, contribution to that. The job the capital serves is not something from an impact statement. It's sort of, what is it being used for? Is it being used to buy the land? Is it being used to, maybe operate, for maybe, putting it into an operating company? And, how does this behave when other parts of the portfolio break? A lot of them also have long time commitments. They're looking for EBITDA in 2065. They're looking 40 years down. They're not going to invest in anything unless it gives them 40 years. Real estate's great like that, but that's not necessarily the same people that would invest in Stripe or SpaceX. But you have a lot of these smaller emerging families that love to go into all of this stuff, and we've had tremendous successes across our portfolio into this. Stripe, that's a great case study, actually, of the next slide that I'm going to go into. Stripe type capital, patient. All right, it's patient. The Collison brothers are kicking butt. They're doing a great job of it. There is optional liquidity right now in these because they're just so big, and the market is just it is so tight. Because if you look at Stripe, management has been ROFRing the hell out of their shares, right? But it's interesting because when we go into this and the different amounts, and again, the money always has a voice. The government's and information rights matter. Stripe has been behaving like a public company already. And if you look at how they're, talking right now, being on podcasts, it's preparing for it's an IPO show, roadshow that's happening right in front of your eyes. It's not anything formal, but they're setting the pace for it too as well. The secondary market, going back to the optional liquidity, there is a lot of liquidity in the secondary market. You can't get shares of Stripe. It is, when we did this last, we were 4 times oversubscribed. So, capital is buying durability plus optionality. All right, people really like Stripe because of that reason. SpaceX is binary by design. There's no yield. There's no timeline certainty. Risk is controlled through sizing. Access and asymmetry matter more than structure. It's the access. People can get into this. A lot of people are selling SpaceX shares on Instagram. I can tell you, if and when the IPO hits, there's going to be a lot of people who are going to be in a world of hurt because they bought fake shares, fraudulent shares, or they were buying forward options on things that never really would that an employee at SpaceX would never want to sell. They're looking for an asymmetric upside and a strategic exposure to this because they're investing alongside some of the smartest people. The sale in SpaceX to most people who are unsophisticated, they look at the cash flow, they look at the multiple over the years, which has been actually exponential. But what we look at it is like, who else is backing this? I mean, you got Peter Thiel's Founders Fund. You have some other sophisticated investors in there. These guys aren't stupid. And this is the kind of money that you want to be with if you have the relationships to do that. That's called bubble wrapping yourself, and we really like it. I mean, we were looking at SpaceX, and going back 6 years ago, I was first having a conversation with someone on this, and I was not ready for it. I was not ready. And then finally 3-4 years ago, we pulled the trigger, and we've done 9 rounds into that as well. And then operator-led real estate. We love real estate. We're allocators. We're not going to go out there. We are not real estate operators ourselves. We're just allocators. The capital today wants control and visibility. Structure. and governance to dominate returns, downside protection, more than pro forma IRR, and operator judgment is the asset. Let me just put this down to you in the way we qualify these deals real quick. Number one, we do not work with first-time GPs or operators. This is why we don't get into multifamily, although a lot of our families in New York got wiped out during the pandemic because the laws became asymmetric, where landlords had no rights anymore, and they wound up being foreclosed on. It was sort of instrumental tangentially to the failure of Signature Bank. Number two, I want to see that they have an audited track record. If their track record is so good, fine, show it to me. And number three, I want to make sure that there's a meaningful co-invest in here. 5% is cute, although sometimes that's the operator rolling their fee in. We get that gag. 10% is thoughtful. Anything more shows conviction. And the operator judgment is the best asset. This is a people business. AI is not going to take over this. And so it comes down to trusting people who have done this many, many times before. Some people are going to want, I put together for our latest deal, which is really interesting because there's been second gens that want to learn the business, and we're actually imparting them into working with our operator. So they'll be, they're young men. We have 2 of them, maybe going on 3. And starting in January, they're going to be sitting on all the investment committees. We have it, we call it a liquidation committee informally. And, these are the kids that get to look over the shoulder with the math, with the models and everything as it comes together. And that was like a big bonus to get a lot of people in with bigger checks, was to say, look, I know your son wants, studying finance at BYU. That's prestigious, but he still needs to worry about getting a job afterwards. And if he really wants to come down this pipe, maybe kind of sort of you should work with these guys. And so that's something where you can have an internship, which is probably something, the best training you could ever receive, working with a world-class operator. And that's where we come to the context of stewardship. Okay. What operators get wrong? Returns. Nobody believes numbers anymore. In 2016, there was a trend I noticed, and I was talking to a hedge fund manager, and I was talking to him about where he gets his information from, meaning where does he really turn on Fox News and make billion-dollar trades off of that, or does he have his own service to do this? And they would have polling services, formal polling services, but the data was just absolutely rich. And what it said was that people were losing faith in figures because they didn't believe them. It could be manipulated. The election of 2016 taught us that. Since then, you hear all sorts of things, and really numbers is a form of propaganda. If anybody gives you a number without the percent, it's propaganda. And I think when you look at things like this, you need to be very careful about where you're getting that information from. And those are the relationships that we had that will allow us to really see where things were going on certain investments that we were making. Nobody cares about timelines. Everybody assumes they're going to be equity splits. You're always going to get the new guys. They're going to drop their pants and say, we'll do 50-50 or, not 50, we'll do, 90-10 or something like that. You got to look at the risk posturing, especially these families don't want to be embarrassed. There's one thing to lose money, but it's another thing to lose to lose face. And a lot of people don't like that. They listen to decision-making under stress. We don't do that because we have an SPV structure. And then governance too, which is important. What happens with this? What happens with that? What rights do I have? Do I get a seat at the table? Not everybody deserves to have a seat at the table. If you send a check for $2 million, I'll give you whatever you want. You're going to ask me, and I said this before, and you're going to give me $100,000. That's a very inappropriate question. It's money talks today, and it's just because you have money doesn't mean you have any rights for any special privileges that come with investing into these deals. And this is the mismatch why a lot of good deals fail to get funded. I see these guys, they're pitching hard. They got numbers. Okay, well, tell me the story. Like, who are the people who are backing this? Who is the lead investor? What is their experience? A lot of these guys, I think, I say before, the cap table is the soul of the asset. And, when we're very proud of our cap tables, and but I see some other people send their cap table over, and I don't know how they're going to work, because everybody has access to $1 million in their lifetime, right? And that you get that one chance to fleece your friends and family, just enough money so you can get $1 million. And then everybody cops out at that because they never think about how they're going to get the next million, right? that's where we come into, building the relationships. I can tell you, we've had some life science companies where, you got to have relationships with sophisticated investors. Last Christmas, one of our companies needed $240,000 to make payroll. And let's just say the week between Christmas and New Year's was very tenuous, but we managed to get it done. And the loyalty from that CEO has been nothing more than extraordinary, and extending his capital, but other people's capital into our real estate deal, which is cool. If you pitch real estate like venture capital or venture like real estate, you'll always miss alignment. There's a lot of weird people in Miami I've noticed who have done this, who are raising money. The best operators don't sell deals, they present capital roles. Here's a great question. Mark, very wealthy Mark, would you like to be on the investment or liquidation committee for our Class A industrial deal we're doing with the X family in Dallas, Texas? Well, I'd love to be. Okay, perfect. I'm going to show you some details of the deal, and I'd like to know how much you're going to be able to commit. Perfect. That's oversimplistic, but if you ask someone for advice, or if you ask them for something where you're elevating their status, it's much easier to get a check rather than shoving down your throat. You're going to get a 22% IRR, which everybody knows pro formas are Latin for lie. Okay. And then on the close here, and then we'll take some questions. I think if you think, not all capital is the same, not all capital has the same needs and wants, the better you understand how capital thinks across asset classes, the less you need to convince anyone. Alignment does the work for you. It's very, very easy. And with that, I think what I'll do is I'll just open it up to some questions, if that's okay. I don't know how we're going to do this. Esteban, my partner, or my fearless better half here, who's managing some of the technology. Maybe you have a few questions, or we can put that in the stream. I'll just wait for a few moments here. And in the meantime, if there's anything or any questions you want me to talk about in future episodes, let me know. All right. I don't see anyone really talking. All right, let's see. All right, perfect. Well, everybody hears me, which is great. That's very enlightening. I like that. All right, I'll just stick around here for a few more moments. You can get an autographed copy of my book. I'll send you where to do that. You know what? I got an idea. All right, I'll do this. I haven't done this in a while, but I will give you. Nope, that's not it. Let's see. I am looking for. There we go. Put it right here. You guys are interested in the books. I know autograph copies can only be purchased here. Okay. Let's see. An office building now. Hold on. Let me see. I'm trying to post something here, but it's not letting me. Anyway, if you go to salvatorebuscemi.com/books, you'll see all my books there. Perfect. Reason why all right, Kevin Quintanilla. Reason why I'm watching today is because I want to introduce someone to you. Okay. Thank you. He recently invested in an office building and now wants to do more. Yeah. Office is making a comeback. Commercial real estate distress will be over by 2026. I don't think there really was too much. I think it was most real estate downturns have been sub-asset class agnostic, whereas this one more or less targeted because of the pandemic on certain asset classes. All right, let's see. Yeah, definitely, Kevin. I appreciate that. Okay. Let's see. Question. Streamlined viewer shows up. I'm interested. Can hear you. Yes, loud and clear. Okay, perfect. How do family offices think about risk when comparing tech versus real estate? It's the difference between a turtle and a hare, right? The hare, if you look at risk, if you get a faster return in these deals, there's a lot more that I always look at it and saying, look, just on the comparison, there's a lot of good things that need to happen over a period of time before we'll realize any sort of return on these venture investments, and it's a long-term commitment. Sometimes that means you have to continue to write checks and pull out the checkbook, which a lot of newer investors don't like to do. But I make that very clear up front that this is this is something where we might have to come back to you again, and they understand that because they're sophisticated, and the people who trust them also understand that too as well. With real estate, the risk is different. The risk is, definitely it's much more stabilized. It's a different asset class. It's a different risk profile, but the risk profile in and of itself is the quality of the operator. That's the most important part. And then also, if you really want to get into it, it's also proximity to major urban centers people really like. So, if you were to look at real estate, New York City, Fifth Avenue, draw concentric circles out of New York City, not all real estate is the same, and it's also very local. I mean, Third Avenue should be carpet bombed right now. And a lot of people would, agree with me on that. But the further out you go, the less, the more tangential you get in these smaller markets, that creates some risk, unless there's high growth there. And that's an entirely different story. But the same risk, if you're comparing tech to real estate, is who's the person you're investing into, and do you trust this person with your wallet? Does that make sense? Great question, Esteban. Thank you. I guess he's getting some messages here. All right, cool. All right, I'll stick around for a few more moments. I do have a call coming up at the bottom of the hour, but I do appreciate you guys here, which is amazing. Esteban, did I answer your question? Yes? Okay. Cool. All right. Nice. Okay. Oh, very cool. I can do that too with this. So very nice. Yeah. What I'd like to do is, maybe you guys, before we, drop off, is to maybe put in the comments some of the things that you'd like to hear me talk about going forward, and that will help me help you. We're probably going to build out a podcast next year, so I'm just using this as a platform to sort of gauge interest in what people want to understand before I go into that. So far, that's everything's worked out pretty well. I'm still going to continue to do this. If you're ever in the Miami area and you want to sit down and watch this live in our conference room, you're more than welcome to do that. So, all right, we're going to start doing a countdown here because I am going to have to hop on another call, but I appreciate all you guys spending an afternoon here on a Friday. You guys are the real stars here. So last time for questions, going once, going twice, 3 times. Ladies and gentlemen, enjoy your weekend. Enjoy your Christmas. Merry Christmas. Happy Hanukkah. And maybe we'll do something on the 26th. I'm not sure. Actually, we won't, because I'll be flying on an airplane heading to New York. So I apologize. We'll do the next one probably after maybe the following week. We'll see, on January 1st. Take care, guys. I appreciate you. Thanks for showing up. Take care.